Okay. What did I do with it?
Columbia PLMR announcing agreement to acquire Advanced Ag Protection, Papalima, Michael Romeo. Financial terms not disclosed.
Icon saying they expect growth in both DRAM and NAND bit shipments in Q3.
I don't know what the hell I do with it. Oh, here it is.
Should see Nike results in about a minute.
Shortly expecting Nike's earnings report.
He said Nike.
Trump signed action boosting U.S. critical minerals output.
Trump signing orders to increase U.S. critical mineral production. Nike reporting $11.3 billion in revenue for the quarter beats $11.1 billion consensus expectation for Nike. 54 cents headline number would beat the 28-cent consensus for Nike. Inventories at $7.5 billion is about in line with expectations.
Gross margin to miss at 41.5%, on estimates of 41.9%.
Gross margins down 30 to 30 basis points at 41.5% for Nike. Again, 54 cents, a big beat of a 28-cent consensus. Wholesale revenues down 7%, Nike correct. Revenue down 12%. Should get some guidance and color on the call later from Nike.
Shares of Nike up some 2.7% after the close.
More thing.
Nike shares up about 6%. on the top and bottom line beat.
What's up, everybody? Let me lower some shit. Excuse my French. Where's my mouse? There it is.
This executive order from Trump White House saying that coal could qualify in the future under this middle order from Trump.
All right. So let's shoot the shit a little bit. I won't keep you guys too long. Some earnings you got out here. Micron looks like better than expected. Nice little pop, $5 or so. Kind of right back to the top of its recent range. Yeah, pretty much. So may help the semis tomorrow, up over 5. FedEx guided lower. And that looks like poop. Did Lennar come out yet? No, Lennar didn't report yet. But up a buck here. And then Nike, I don't know if anybody cares. That stock's been miserable. What a travesty. Look at this thing. So FedEx, you got a little bearish and bullish tint to earnings tonight. FedEx bearish, Micron bullish. All right, let's talk about the market, and then we'll go through some of the things kind of back up what I'm seeing here and kind of what we talk about for those of you STEAMROOM members Sunday night. I think we're getting more evidence of kind of what we've been talking about on Sunday night and the last few times we've spoken in regards to the market backdrop here. You've had a pretty aggressive, again, not just the price action, but as a market term, de-risking into this downdraft, right? So this drawdown here was not only aggressive and violent in the price action, because certain facets of positioning had a full tank of long exposure. You had them kind of all de-risking at once, right? So you kind of get this no bid, and where you're down, it feels like every day for 2 weeks. The good thing about that, when you get a drawdown like that over a short period of time, instead of that drawn out process with squeezes in between, is a lot of that de-risking gets done, right? So once the dust settles a bit, that supply, that concern, right? The main reason, and this is kind of what we've been talking a lot about, the main reason we were cautious up here, on top of signs from the flow that there was no new risk being put on, was that if the market did lose some steam, momentum-wise, there was some supply that was going to hit the market, right? You're going to have a decent amount of supply. And that's kind of what played out here. So I think what we have now is, because of how aggressive it was, you got a point where you have a higher probability now of some relief, okay? And give you 2 market examples. Okay, I know a lot of people like to use the line, what does it go? Market history repeats or rhymes, whatever the fucking guys say. It sounds cute, but you don't want to get too wrapped up in looking at past cycles to try to determine what you're in now, because it's always something new, right? I mean, I get a kick out of when people are posting 1929 charts and overlaying it with the current price action now. Like anything that was going on in 1929 is going on right now in 2025. So I don't want you to think I'm doing that, but pictures sometimes do it more justice than describing it in words, right? And that's what I like to show you guys. So I think we're at a point here, kind of, you know, we've been talking a lot about how, you know, even before the market rolled over, had a late 2018 type of feel to it, and it still does. Okay, not just the tariff thing, but just the buyer strike, even the aggressive sell initially, and now, you know, the possibility of some stability. So if we go back to 2018, late 2018, I want to show you guys how kind of that played out, and you get an idea, right? So here you had a drawdown. We had a little stutter step here. We didn't get that this time. We just continued to sell, right? But you had a pretty aggressive drawdown here, and a lot of de-risking took place. So a lot of funds and players that were caught long, they took down their risk in a pretty aggressive manner into that drawdown. All right, they got shaken out. And at that point, what you had here is very similar to what we have now, where there's a higher probability of stability because a lot of that aggressive selling, right? Because you think of like these systematic funds, there's no emotion involved. There's no thought involved, right? VIX breaks levels to the upside. SPX breaks levels to the downside. They just have to take down their exposure. There's no choice in the matter. They're very systematic, right? So that's what feeds into this. And now because of the dry up on that end, okay, that's where you get, you know, a higher probability of some stability. Now, stability can come in different forms, right? Sometimes you can get these violent snapback rally over the course of a week, right? And they get overdone that way in a sense. Another form is kind of what we're seeing here, right? Where buyers don't show that same excitement to buy the same names that they got shaken out of. And you get more of a choppy kind of relief stage. Okay. And right now, with the evidence we have from, again, and it's early, still it's early because we just experienced this drawdown a couple of days ago. But with the information that we're seeing, the evidence we're seeing, it's looking like something like this, right? Now, before I go on, we don't want to jump the gun, right? Automatically, the perma bears out there, they're looking to this already, right? Oh, we still have that to come. I'm shorting every rip. In my opinion, this hasn't been concocted yet, in a sense, right? I think for that to happen, we're going to have to see one of the worst case scenarios play out here, meaning that maybe the economic data gets worse than people are expecting. The Fed is more stubborn than people are expecting. So you still have things that I think that need to play out in order to determine whether this happens, where you get another leg lower, or, and here's the other example I'm going to give you, and what it looks like to me is the possibility of something more like this, 2011. And I remember 2011 because it was a pretty cool rinse. Let me see, where are we here? So 2011, if I remember correctly, was the government shutdown was involved in that. Okay. And as you can see, you had a really aggressive sell, right? So resembles what we just went through here. Okay. And look at this kind of chop and relief we had to deal with here for a period of time. So you get this, right, in a matter of 2 weeks, and then this over the next 2 months. Okay. And why I think this is more than likely to resemble this, even though this drawdown, a lot of good came out of this drawdown, meaning you got the systematic funds flushed out. You got a lot of the things that were leaning a little too offsides on the long side flushed into this rinse. In my opinion, you don't have enough now. You don't have what you normally see at major lows currently in what we have now. In other words, there's still things there. There's still some work more work to be done. We could talk about that, okay, if you like, but I don't think we're quite there yet. And like both in 2018 and 2011, same instance, you had really aggressive de-risking over a short amount of time, but big picture wise, it still wasn't that full cleansing that needed to take place. And ultimately, okay, this got it there, right? Because you didn't get that much relief. So you really didn't have to wash out any added bulls that came into the picture, okay? And when you broke new lows here, you could just sense how bearish people were, thinking another leg lower was coming. And at that point, you kind of had everything you want to see at a low, right? A complete cleansing of bulls, max short CTAs, hedge funds max short. You kind of had everything you wanted to see at or near some of these major low points. In both 2018, it took a little more. In 2011, it really just had to take a little breach of the lows. Okay? So, again, markets, I'm not saying we're going to trade mirror image to any of these things. That would be foolish. Okay? But to determine what ends up happening at this point in a couple months from now or in a month from now, I think it depends on a lot of things that we can talk about along the way. There's no reason to try to predict it. It's a losing feat. Okay? It's a losing feat. But in the interim, I think there's a higher probability of a release stage like what we see here in 2011, 2018, in where I think if you, especially those of you who trade both ways, which is a really difficult thing to do, especially emotionally, you try to lean bullish, but you want to be smart and prudent about it, right? If you're anticipating a more choppy environment and not a V-shaped recovery, right? And why wouldn't we expect a higher probability of a V-shaped recovery? Because you don't have that full cleansing, right? You're at a later stage in this recent bull trend or bull market, whatever you want to call it, that we've been in, okay, that you don't have the things lining up to kind of set up that V-shaped recovery, okay? And we're kind of seeing it right now, right? Look, you got names that people and players are usually salivating over, right? Tesla smashed, right? Mag 7, a lot of these names have been chopping around for 7 months and have gone lower. And there's just not that excitement, especially out of the flow, right? Forget about the price action, but both. You just don't have that excitement where people are looking to put these names back onto their books in a big way. Okay, and we're already seeing that. So that's why that in my opinion, I'm not playing for that V-shaped recovery yet, right? Once we get to a point where nobody is long anything anymore, and matter of fact, they're more likely short a lot of things, then you can feel better about getting a little more aggressive because the majority of selling is already done in a sense, right? That's the conclusion you can come to. All right, and as the flow goes, that kind of dictates what we want to do, right? If we're seeing flow get aggressive in certain areas, and if we like the names that are being bought up or sectors being bought up, especially at spots there now, you can look to get more aggressive. But if we're not seeing the flow light up the board in certain areas that you're looking for, in my opinion, I don't think it's smart. I mean, I wouldn't get aggressive in any of these areas that we're not seeing the excitement there. I would be a lot more patient and smarter about entries. Okay, and then like I said, you can try to predict what this is going to look like. Everybody has a prediction. I don't think anybody's prediction is worth more than anybody else's, so you're not going to talk me into it. But I think ultimately what determines whether we finish up like late 2018 or we finish up here like 2011 is ultimately going to be determined by a number of things: sentiment, positioning, flows, on top of, I think, economic data and the Fed. All right, so you got a lot of things that go into that mix there. All right, so in the meantime, we kind of tackle what's in front of us, right? We try to take advantage and play what's in front of us, and that's kind of this, right? So this is kind of the playbook. We gotta utilize the playbook for this type of price action. If it's a little bit better, a little smoother, a little easier, even that's only going to be good for us, not bad for us, right? But I think this is kind of the price action we kind of got to look for here. So let's fast forward, right? And if it was to look like something we can draw up, right? It's a more a choppier. You know what I mean? And, ultimately, right, to get back to this downside niner, right, 58, 5,900. Okay? I mean, it's obviously not a big move, and it's very realistic. Okay? But I will say this. Outside of the indexes, and I know, there are a few of you or many of you who just play the indexes, just care about the indexes, and are going to try to predict up and down every day. I think the indexes off of weakness, off of down days, that's where you probably more than likely will find better entries for trades playing the indexes or things that rely on the indexes. And I think individual names and sectors and subsectors, pockets, I think that's probably, hopefully, where there'll be a lot more alpha. I do remember that late 2018, that period of stability, there was definitely money to be made on the long side, trading the long side in that relief period. Because even though the indexes were choppy in a sense, there were certain names in certain groups that were, they weren't nearly as choppy. And they had a lot more momentum. All right, so like late 2018, again, looked like this. We were looking at 2011. So you kind of have an up, down, right? But within that, there were named sectors that outperformed. You understand? When the market went up, they went up. And when you had the market go down, they kind of held up a lot better. And then when the market went up again, they had another leg higher. So you had things that went higher. They could be defensive in nature. Like, look at what we're seeing now flow-wise, right? Still extremely selective. Okay, again, it's early yet. We just finished that down leg, right? So we just got started here. But, extremely selective. Not even a lot of short-dated squeeze sweepers in some of the more active, popular names that everybody likes to play. Names like Freeport have been seeing the best of action. FCX, financials, RKT, right? You got names like that, K-View, which is, I guess, healthcare. So it's early, but you see a little more of a cyclical defensive wrinkle to it in a sense so far. And that may be how it plays out because of this kind of growth scare slowdown that's weighing on markets right now. Again, I don't think it's just tariffs. The media wants to talk about tariffs, the noise. They don't even know if tariffs are inflationary, deflationary. Nobody knows what the hell they're talking about at this point. I think ultimately what's kind of rocking the boat here market-wise is, anytime you have tightening like we've seen from the dollar, we talked about it. You had that rip in the dollar, usually leads to some sort of growth scare, right? We were talking about that before even the market, people were even thinking about growth scare. And I think now you're starting to hear about it. All right, you got the economic data, which has been weakening. Economic data surprise indexes. If you look at it, I just posted one. Oh, I have it here too, right? Let me see. Did I post it here? I think I posted it on my Twitter. Hold on. Wait. Oh, wrong Twitter. All right, so this one's out of Goldman. Some are worse than others. Some are better. But you can see how this has ticked lower here recently. All right. And here's the last nugget before we kind of look at the proof of why this may set up that way. Late 2008, it's almost always the Fed pivoting that ultimately happens at or near the lows. Okay? Sometimes it looks like it's not likely to happen, right? Late 2018, just to give everybody a flashback, Powell was pounding the table that quantitative tightening was on autopilot and wasn't going to be touched, and the market wasn't going for it, right? Okay, when it was all said and done into the lows of late 2018, not only was autopilot dead, the Fed was implementing a form of QE. Okay, so even though it's not likely and the market's not pricing in rates and blah, 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 I get it. But almost always, when the market wants something to be done, it gets done. All right. So we'll see. Right. And that, again, that at the end, right, that last stage of this, whenever we do get there, that's going to likely determine whether we got some more volatility and weakness to deal with before the turn comes, or it happens a little sooner than people think. That's why I think predictions you can flush down the toilet. Here's some of the proof, some of the evidence that was, again, we talked about this, if you remember, on last Thursday. For those of you who aren't STEAMROOM members, we were talking about a stage of stability here. We were looking at some of the signs out there, right? You had VIX, which you really had an aggressive move. Things like the vol panic index were up at high levels, right? That you usually don't see with a 7-8% correction off the highs. All right, so you had a really big, strong bid in VIX and volatility. So you had this is the vol panic index. This is as of, I think, a couple of days ago, up at a high reading. Okay, VIX has already rolled over. VVIX, the air came out of the balloon there. I don't know if you guys looked at VVIX over the last few days. Complete unwind. Okay, here's the daily sentiment index for VIX. You don't even have the S&P 500 at buy signals yet, but you had VIX approaching levels we haven't seen in quite a while. This is COVID. This is that late 2018. Here's 2015-16, which was rough. Okay, so volatility and the aggressive bid and volatility was definitely one of the things pointing to some stability here. We talked about this. These are Goldman funding spreads, right, which measure kind of leverage in the market from the pros. And before the market rolled over, if you remember, we were looking at these things. They were indicating, and a couple of traders at Goldman were pounding the table on this, that even though the markets were holding up well, making new highs, everyone's bullish, some of that smart money leverage-wise was taking leverage out of the system in a pretty aggressive way. And that's what you see here in this red line, okay? You got good news, bad news here. The good news, they're not aggressively putting it back on, right? A lot of the V-shaped recoveries, that's what you normally would see. Okay, they take advantage of this yank and they start to lever up again. So that's the bad news. The good news is you kind of got a little breather here now, right? They're not, I guess the bearish case would be they continue to be aggressive and take some more leverage out of the system. Okay, so you got some stability here, and that also would point to a little stability in the equity markets. This is month end, so now you got flows wise. Okay, a lot of the flows were all bearish, right? Everything, I mean, as far as flows were concerned, were pretty bearish. Of the last few weeks into the drawdown, starting with systematic funds and all that stuff. Now you have them starting to tilt bullish, all right, because of the pullback in equities in relation to bonds. You got pension fund rebalancing at the end of the quarter here, at the end of the month, that now lean pretty bullish for equities. Okay, so that's an added bid in the market. Late 2018, if I remember correctly, I am almost positive that was one of the big things. You had a big bullish rebalance from pension funds. Okay, because of that drawdown in late 2018. So that's what this is kind of showing there. I got another chart here showing similar, all right, month end rebalance. Okay. Here are CTAs, I think. Wait, I did that already, Bob. Oh, here I am. CTAs, if you guys remember, we were looking at it, sell side, everything, right? Either up, down, sideways, crooked tape, CTAs, all to the sell side, okay? Because they were already extremely long and couldn't get any more long at that point. Here, you got you got pretty much the opposite. They've de-risked so much that they're now, you can see on the bottom of the chart, they're actually net short, okay? And if you look at the flows over the next week, U.S. markets, bullish in a flat tape, bullish in an up tape, bullish in a down tape, all right? Over the next month, bullish in a flat tape, bullish in an up tape, bullish, slightly bullish in a down tape, okay? Again, a lot different than what we were seeing into that drawdown over the last couple of weeks. Ideally, what you want and what you normally see when a quote unquote true correction runs its course is you get the opposite of what we had before this pullback. You had systematic funds basically with a full tank of gas, okay? No matter what the equity market did from that point, the systematic funds couldn't add any more additional exposure. Okay, they were already max long. And what usually happens in these true corrections, they get to a point where they're max short. Okay, and no matter what the price action may look like or what VIX may be, they can't add any additional short exposure. Right? And they're more inclined to cover, and kind of this is what this is pointing out, they're more inclined to cover into any additional weakness. So you can see how that could be a pretty notable changing character, right? And when they're max short, you got kind of that elastic band. You got a nice bid in the market if there's any additional weakness, but if the momentum starts to roll the other way, that's where you get these systematic funds start to chase and plays a big part in these V-shaped recoveries. All right. As of right now, and I think I'm reading this correct, for them to get to max short, you're talking 54.34 on SPX as of now. I think that's what that means. These are a couple indicators I like to look at. I like to look at a lot of these things in corrections, but from Sentiment Trader, they got a bunch of cool indicators. This is smart money conviction. Again, more smart money is a term thrown around way too loosely. This is more of contrarian indicators, right, that are successful. That if you backtest them are successful, right? So when the market pulls back and they flash bullish, they work. That's their kind of definition of smart money. And you got to buy, you got a bullish signal there. Okay. Then it can linger. Is 2018 on here? Yeah, it could, right? So you see here, kind of we flashed bullish, had a little rally, came out of bullish, and another rally, right? Back and forth, and then ultimately the rollover there, all right? So you could kind of play ping pong here a little bit, but again, higher probability of some stability when this thing gets up there. This is fund flow. You guys are probably familiar with this. Ridex, all right, sector fund flow. They also got like the Nova Ursa fund flow, they call them. So in other words, when the climate, the backdrop is bullish, they start to get aggressive in these bullish funds, levered funds. When they're bearish, the price action is bearish, they get aggressive in these bearish funds. When it gets to an extreme, a lot of times it's a pretty cool signal. And that's what you're seeing here. We kind of bounced out of that a little bit with the little bit of bounce we had. But into the lows, you can see it below the green line. You had one here, kind of nailed. Well, actually had the summer lows in 2022 and then the ultimate lows in 2022 here. Here's the 2023 correction. This is the COVID crash, so that's a little bit different. But here you can see some of the others. Here's 2018, the first drawdown, then a bounce, then revisited into the leg lower a couple months later. All right. So again, a lot of these things that you normally see into a tradable low, or as I like to call it, a relief bottom in a sense, have been showing up here. Major sector breadth. We've been talking about that, right? Internals breadth, pretty decent washout because of how many days lower without really bouncing. Major sector breadth got to zero, right? When it gets to floor to zero, that usually creates some decent relief. So just a lot of these things here. AAII, if you remember, a lot of perma bulls were pointing to this indicator a little on the early side. But, you had now you're at significant washed out readings alongside a lot of other things. And I think that's it. A couple other things that updated today. Here's NAAIM. So this is more on the advisor side than if you look at AAII as investor. You got, decent wash there. So all the things you wanted to see, like here's something I would like to see a complete washout for. A lot of times you see them at major lows. This Goldman risk appetite indicator, you're kind of halfway there. You got more work to do on a lot of things for major bottoms. Here's Investors Intelligence. That's newsletters. So newsletter sentiment. All right, nice washout there. So you got a lot of things. Here's one we want to see again, like the CTA is max short. We want, right? Like, when has there ever been a true bottom without hedge funds max short? I can't remember any. Okay. So again, good news. They are not long. If you remember, they bought that initial dip, which kind of concerned us, right? That was a little bit concerning. But they didn't go above there, beyond there. They kind of got rinsed, and they've pretty much been hedged, living up to their names. All right? They have been taking a nice hickey because their long book is flooded with mega cap growth and some of those crowded names. So they're taking a nice ass kicking there, excuse my French. But overall, they're still in single names, they're hedged. Let me see. What else? Here's AAII, by the way. So a little off the lows this week, but still bearish extreme. Our short-term sentiment indicators that we look at in the steam room off this bounce that we have. Obviously, these things are more neutral in a sense, but these things really move pretty actively on a day-to-day basis. They're short-term signals. There was something else I wanted to show you. Fear, greed, a lot of you look at. Here's kind of a better look, in my opinion, fear, greed. You can see where it's been, right? Not just in the pink area that a lot of riffraff on social media like to look at. All right, but now, you had a pretty significant washout here. Panic, euphoria. All right, So a lot of these things that I like to look at in corrections, a lot of them. Let me see. Anything else interesting while I'm flipping through things here? That the put the call, right? A lot of us were waiting for a put the call and stuff like to elevate, and it has. I guess that's it. Okay. The issues, I think, like what to be careful of, where it can kind of throw a monkey wrench into some stability here, in my opinion, comes down to the credit markets. If we see a period, if we see during this period credit spreads start to widen out aggressively, credit default swaps start to widen out aggressively, that's something you really want. You don't want to try to get in the middle of. It's just not worth it, because again, algos go on insta sell, auto sell, as I like to say, and equities really find a tough time. Okay, so we definitely want to keep an eye on our credit market indicators, and I think the flow, even though it has been discouraging to this point, but during these relief periods, you kind of want to see where the momentum is at, because the problem is, even though I think if we do get this relief period, net, you're likely, from the washout we've had, you're going to have a lot of things that trade higher from those lows. But if you're chasing rallies in some of these things, especially some of these crowded names, there still could be, because of how crowded they are, there still could be de-risking still to be done there. All right? So what I'm expecting is more of a market, kind of what we were seeing before we had this drawdown. A lot of dispersion, right? A lot of rotation under the hood, not a lot of participation. Now, don't get me wrong, there'll be days, and that's where I think you kind of want to look at those credit signals, right? If you see a nice pace of sweeper activity and credits confirming a rally, I think those are the days where you can get a lot of those trend days. You can get more participation. Some of the names you like to trade will participate. But I don't think it's going to be the norm. I don't believe it's going to be the norm in this period. Okay, so I think that's where that's where we're at right now. Right? I think, and listen, there's going to be noise along the way, and I'll leave it at this. And this is what I kind of been trying to pound the table home for STEAMROOM members. Whether it goes in one ear or out the other is up to them, not me. But if you were in an elevated cash position, right, because of the things we were seeing ahead of this drawdown, okay, this is not the ultimate goal. This is not the primary reason why. Well, let me take that back. The primary reason is not to lose money. That's the primary reason, right? But again, I guess the better way to put it, the pot of gold at the end of the rainbow is not this. Okay? It's not to just come in, try to nail the lows and pound your chest on Twitter. All right? That's not why you came into this with cash and ammo to fire. Okay? It's to have the ammo and the bullets to fire when that real turn comes. You understand? And sweepers are tattooing names, and there's 5, 6 names you would like to own, but usually you'd be holding bags and you're scared shitless because you got caught in a drawdown, right? That's where having that elevated cash position in the ammo to fire really makes a dent. Okay, it's not to nail the lows. You don't need to nail the lows to make a dent coming in with a cash position. You don't need to nail the lows. You can be late, and as long as you have the bullets to fire, you're still going to make a ton of money. Yeah. So at the same time where you should be proud of yourself for being in a cash position and not getting greedy when some of the signals were telling you not to, you still need to be patient here, because again, it's fine to play. You see some flow in a name that you like and you have no exposure on, and you want to at least put some exposure on now because you're looking for some relief. That I'm not saying overdo it, but you want the ammo to fire to be aggressive when you need to be aggressive, when everything is lining up and telling us to be aggressive, right? When sweepers are tattooing things, when credit is confirming that they're tattooing things, and the wind is at our back, and we want to get sloppy long. All right, that's the time where you could get sloppy long. Not always, but that's the time when you could get sloppy long, where you can throw a dart at any decent sweeper that hits the tote board, and you're likely going to make money on that trade. All right, that's what you want to be around for. Have your eyeballs open and have the bullets to fire. All right, so being patient here is not a bad thing. Yeah, I run the same trouble. What happens to me a lot, guys, is, again, because I've been doing this for so long, is that I'm okay with getting into cash early and not having FOMO missing additional upside, right? If the action from sweepers is telling me that they're not getting excited about anything new, and you're getting credits telling you different things, Sharpies ahead, the further upside in the indexes doesn't bother me. Okay, my problem is if that period of me being in an elevated cash position goes on for a lengthy period of time, I get used to that. You understand? That feeling of not losing money ends up becoming a really good feeling, and you become gun shy. You understand? But that's usually over a lengthier period of time. So, but being patient, continuing to be patient here is not a bad thing at all. McElliott been quiet? Not really. I think probably because he doesn't have really anything new to say. He kind of was pointing out that you may get more of vol down, price down type price action because VIX was just overdone to the upside, and positioning was a little lopsided on that end. But he was pointing more towards kind of what we don't want, and that's that dispersion, that a market where you have kind of this period of relief, but it's tricky. It's tricky, and prior to really recent, we haven't had to deal with that much, right? Every little pullback was kind of a V-shaped bottom, and especially off the lows, you had everything participate. And then as this trend got longer in the tooth, that only lasted for the first week rally off the lows, right? And then we would get kind of more of a mess. That was a sign that we were running on fumes. So that's kind of where he's left it off. And, if he has anything important to highlight, I'm sure he'll be pointing it out. But again, right now, I think for us and a lot of our styles, especially for STEAMROOM members, I think when you're seeing sweepers, no matter what they're playing, right? Like usually we're looking for quality flow, right? Ideally, like that's where we want to build baskets and positions off quality flow. Okay. But even if we're not seeing that now, right, because of the possibility of a relief stage we're in here, if you're seeing aggressive action in weeklies, okay, so if you're seeing a healthy appetite for weeklies and speculative flow, and you get credit or credit signals confirming risk on, that's where I think you want to try to pick up the money on the long side during this period here. All right? For however long it may go on for. And again, I don't think anybody knows, I don't think anybody knows. It's all going to be depending on how things shake out. Like, look, you got here now, I think even seasonally, things line up a little bit better. You had Trump where he was really aggressive with tariffs. Then, the market took a nice little hickey, so he kind of chills out a little bit. Then at the start of April, you got that flaring up again. So you kind of you got to navigate that in a sense. But if you're seeing decent buying in names you like, quality buying is what I'm getting at. I think it's okay, even if you want to start taking stabs at names with time. If you see that buying come in, because again, for all we know, the worst could be over. I don't care what any bear has to tell me. You understand? The worst of the damage can be over already. Okay? Doesn't mean that it's clear sailing and you can buy anything you want, even if you knew that information. You know what I mean? Again, I give you guys the example just to remind you. Off the 2022 lows, okay? If you bought the Mag 7 names, if you bought a name like Tesla or Amazon off the 2022 bear market lows, which a lot of retail players did, okay? They nailed the lows, but they still lost money because ultimately those names traded lower the rest of the end of 2022. Okay, that bull trend didn't really gear up until 2023. So what I'm getting at is, making these predictions, and ultimately these predictions are just to pound the chest. If you're not bragging, if you're not out there making calls, right? What's the point in trying to predict what's going to happen 3 to 6 months from now? What we want to see with no bias whatsoever. No bias. You want no bias whatsoever. You want to come in every day, see what buyers are doing, where they may be getting aggressive, if they're getting aggressive at all. Right? You want the evidence to build. We want the evidence to build up to convince us that there's a higher probability scenario of something playing out. Right? If we don't see, right, that's a signal in itself. If we don't see aggressive buying and aggressive accumulation in much of anything, okay, and it remains extremely selective like we're seeing, that's right there. The signal out of the flow is telling us that there's likely going to be some sort of retest, if not a leg lower, down the line here, right? That they're not ready. So that's what I mean about evidence. Again, if you're not following flow, which, obviously for me it's a big deal, but the price action tells you a lot, right? If you're seeing certain groups, certain sectors, certain names, as the market sells off, even if we go and make new lows or test new lows, whatever it may be, and this group and these names are holding up well and higher lows and right, carving out the bottoms and the right side of that chart, that's early evidence of possibly that group leading us out. Again, 2022 example, everybody and their mother was calling for a recession. There was no way not to get a recession, right? The evidence, as far as trying to make a prediction. But as everybody was calling for a recession and a blow up of a housing market, what group was starting to look the best before the market even made lows was the housing sector, the home builders, right? So if you have the cash, right, you have the ammo, and you have your two eyeballs, okay, open, and you can block out the noise, there are going to be clues along the way that give you much better odds than making just a bold prediction so you can brag in a chat room or on Twitter. Yeah, I mean, tax season, this all could be playing a part. The tariffs, the tax season, all this stuff. I think ultimately I don't like to get too wrapped up in all that stuff, okay? Because that's what builds biases, right? You can think, oh, tax season's a big bird, or tariffs are a big bird, and then you get all buried up and wrapped up into that thesis, and the price action, the flow is telling you something different, and you don't want to listen, But plain and simple, I just think that, again, just being in this game, when you have wrong thing. When you have a cycle, it's on here, right? When you have this go on, okay, and you have financial conditions tighten, you have yields going higher, right? Ultimately, there's some sort of growth scare that comes out of that. It's not when it's happening, it's after that happens. And I think we're dealing with that now, you know? And then the market's going to look ahead, right? And then start to tell us what the market's pricing in. Again, not the news in front of us, the future. The news in front of us does us no good. The market ate it, digested it, and shitted it out already. No, but ultimately why I think we're not done yet, whether it's more chop or a rally and a revisit to new lows or a leg lower, is because, like I said, the major lows, right? If you go back throughout the years, throughout history, as long as I'm in this game, the major lows out of corrections, right, legitimate corrections, when you get a correction, you get a full cleansing. You get a full cleansing of positioning. They don't let anybody survive. They don't let anybody survive. And, you got some things that still haven't been rinsed. I mean, here, let me show you another thing that hasn't been rinsed, right? That we talk about here. Let's see, where am I here? Oh, this is, let me go to Friday, which tomorrow's Friday already. You believe it? I can't believe it. Okay, here's, this was the weekend. Yeah. So I'm right here. We talk about Sharpies, right? That's another signal, right? Sharpies will more than likely take off their hedges. Here's Sharpies going into tomorrow's update. Okay? Here's the zero line for those of you who can't make it out. All right, so Sharpies are fully hedged into this drawdown. They're pretty aggressively hedged. Okay? When positioning gets to that cleansed state, you're going to see them take off their hedges. Plain and simple. That's why they take off their hedges. Because the other side of positioning is on the other side. Right? Now you look at this. Here's just riffraff specs, small specs in the futures market. All right? This is going into tomorrow now. Look. Okay? You're likely going to get a rinse out of this before this process is done. Now, is there a stage of relief for a month before that happens? Certainly possible. Is there a rally to 5,900, right, before that happens? Certainly possible. But more than likely, before this correction has run its course and you have the setup for a new bull trend, all this stuff gets washed out. And again, the perma bull in me, and you guys, I've been saying this for a while, the perma bull in me, okay, if this works out the right way, and the market has a habit of working out more than it doesn't, okay, just numbers wise, okay, Armageddon, when you play for Armageddon, it's usually not a good bet, okay, but anything is possible. That's the beauty of this game. But what you got going on now is you got, obviously what it looks like is the White House is purposely trying to slow shit down. Right? We talked about it. You can't blame them. Right? From where Trump got in, he couldn't step on the gas the way he likes to step on the gas. Okay? Right? The price of eggs were going parabolic. If you step on the gas at that point, the price of everything goes parabolic. That's not good. So they're literally trying to slow shit down. By doing that, they'll get interest rates lower. They get the Fed back on their side, right? And then they can look to slam on the gas. And what I'm getting at is the perma bull in me feels that if it happens to work out the way they like, coming out of this, you can get a true bull market, which I think we just didn't have. Okay, you had a strong bull, right? Especially in AI and mega cap. But you really didn't have the ingredients, in my opinion, of a true bull market. You didn't have the characteristics of a true bull market overall. Right? And it was a defensive bull market the majority of the time. Anything tied to macroeconomy, those stocks didn't do shit. Nobody wanted to own those names. So coming out of this correction, you can have a true bull market. And that the corrections are good, right? You remember last week or the week before we were looking at the chart. Those were the 90s too, the mid to late 90s. How many corrections? They were totally normal. Only 2000 turned into a debacle. And again, 2000, unless you were buried in overinflated tech and internet stocks, right? 2000, if you had cash, was a great opportunity to make money in everything else. So I think there's a lot of good that can come out of this. A lot of bullish that can come out of this. No, but you still got some work to be done. All right. And I'll leave it at this, right? At the same time, while there's work to be done, I got to remind myself that I don't want to get in the habit of waiting for all that to be done if I'm seeing signs of risk on going on around me. In other words, if sweepers are tattooing things, okay, no matter what they are, I can't fall into the trap of waiting for everything to get cleansed before I look to take advantage of it. Because it may be a 2000 situation. Right? It may be a 2000 situation. You may have a full-fledged bull market in small caps or in certain cyclical parts of the market, while NASDAQ and mega caps are not done correcting. All right, so like ultimately the flow is the confirmation. Here's one more for you while I'm up here. This is the kind of the economic surprise index in an indicator form. And again, growth scares, usually you get close to that green line when it's all said and done. Who's that? Growth scares, you get close to that green line. Again, growth scares, not every correction. I will pull back because this is economic surprise. But growth scares, you usually get down to near the green line, and then you get a turn, and the data starts to turn, and cyclical, more economically sensitive names do well. All right. So the name of the game, here's another one, risk appetite. All right. This particular indicator from Citigroup, UBS, or whatever it's from, completely washed out here. Excessive pessimism, spike there. So again, think of it as a period of relief. More of the story, guys, and I'll give you a couple names that have been seeing a little bit of flow, and I'll let you run. I think we look for that period of stability, especially off down days of selling, weakness, right? That's where we want to look for opportunities. Intraday, very similar, off of fades, off of selling. You see pickup and sweeper activity. You see credit looking better, that sort of thing. We want to try to lean bullish, take advantage of some bullish momentum, however long it may be around for. The more the merrier. And then just keep an eye on the evidence in front of us, right? Don't get too far ahead. Don't get too far ahead. All right. Flow again. Flow, there hasn't really been a whole lot to talk about yet. It's still early, right? We're a couple of days into stability here. But I bought some of this K-View. I bought September calls here in K-View. All right. Not a bad looking name. Has been seeing action. It's been sticking out like a sore thumb because not much of anything else is catching action. And this is a spinoff from J&J. Okay, so we may see more names like this start to catch the flow. We've been talking a lot about this FCX. And it's a tough hold. You know what I mean? It's a tough hold. So if you have the room for agita, if you're not going to get stressed out by giving up gains and reversals and all that jazz. I mean, they're buying it. They've been buying it pretty decently, nice size. May calls, right? Primarily, I think it has been. You're going to get earnings soon in a few weeks, so just keep an eye out on that. The main thing, which has been frustrating from the few people I know that played FCX off the flow, copper has actually done well, but the FCX has lagged. The copper stocks have lagged, so that's frustrating. That's frustrating because it was kind of a play on copper, right? CTAs were max short copper, so you had a real nice setup there. I think we kind of went over that if you remember, but unfortunately, the names, the equity plays on that, up until recently, haven't really done a whole lot. All right, it's kind of these kind of been really choppy. Net higher, but not smooth at all. What else? China stocks. Again, I don't want to spend too much time on that. That's had momentum. There's been flow there. A few of the names really had big runs. They're digesting those gains. I haven't played names. The ETFs I own a little bit of that I've owned. Yin and Chow. Yin small, Chow a little more, May calls. What else? And, banks. They're still buying dips in banks. All right, we saw like a JP Morgan risk reversal into some weakness. Citigroup, they did a little put selling yesterday. So the flow in banks has still been bullish overall. And again, I think banks still will find buyers into weakness. But what a lot of us look for out of the flow, new names, new ideas. K-View, if you want to put it in that category, it's really not a growth type name. That's the only one. VG, we saw a little bit of action before earnings, which was earnings flow, right? So over here. But we haven't seen a whole lot since. I know it's been in the news, but honestly, there's been other gas plays that have been seeing better flow, if you ask me. This next has seen probably the best flow out of anything out there. The whole stock universe. This next. I don't know anything about them. All I know it's a nat gas name. No revenue. So, I don't know what this shit is. All I'm telling you is there's been pretty aggressive buying in this. EQT, I own this name for a while now. I sold a chunk of it, but I still have a piece that I'm kind of holding longer term. You guys remember it back there last year. They still buy it. They're still buying this on dips. Rolling, but also some buying there. And what was the other? They all look okay though. All these names look good. AR, right? So again, VG is kind of, I guess, the laggard. What you're looking at out of it. But there's been better flow in other names in that group. Well, T10 I'm still holding, yeah. But, again, I'm not selling it, Shank. I'm not selling it. T10 I'm holding, TEM, but I got 1,000 shares in these things. I don't have, you know what I mean? TEM, like, I didn't even sell that rip. It's kind of a tuck away thing. My soon, like I did with soon. So T10 and TEM I own. RBRK, I think you asked me about that, Shank. I'm still holding that piece of RBRK. I'm not selling those things. Those are things that almost semi-investments in a sense. I want to kind of forget about them, and then maybe I get lucky with them kind of thing. Now, T10 in particular, if they come after it at some point here, I'll add, Shank, no doubt about that. If we see sweeper activity show up in T10, I'm going to add, definitely. RBRK, I'm not going to add up here if they come after it, I'm not going to add up here. But T10 I'll definitely add to. Definitely. Yeah. We talked about it, kind of a small piece just to wet the beak, growth names. And, if they really come after it, if it's still down here, I'll definitely add to it. Shank, I don't have to tell you, the new names, the new potential leader type names that we like. I mean, it's been dry, brother. You know that. I see you screaming at me every day. I see you screaming at me every day about that, about the flow there. KRMN. What is that? KRMN. Oh, I like it. What do they do? You're dying. I know, brother. I know. You don't have to tell me. Engaged destined manufacturing sales of dependable missile systems. Nice. This doesn't trade options, Shank, yet. Interesting. Yeah, I see that. Nice move here too. In this tape, very nice. But yeah, Shank. We needed, as you know, we've been talking about it for a while. We needed a correction before we can get to the place where we can see more of these type of names. So we finally got that correction. You understand? We needed that before we can even think about it. We weren't, it wasn't happening. Mobley, I haven't seen any action in Mobley in a bit. The last time we saw her, here's the circle. There you go. That's the last time we've seen action kind of pick up in Mobley. And into this squeeze. But I haven't seen not any clean action in Mobley. There just hasn't been a lot of clean action at all. After post-election, when you kind of got everything else involved, right? They kind of squeezed everything else, and you didn't have any new names surface, kind of what Shank and I are talking about. After you get a rally, okay, these names are already bought, right? They were saturated with buying squeeze sweepers. They're rolling. So you need new names to start catching action. Otherwise, it's going to dry up. And that's kind of the pickle we ran into early this year. Again, the good news is that you need a correction to kind of wash it out, right? You need that first before you can even start thinking about it again. And we got it. You don't realize how important that is. Corrections are really good, constructive. You know, you guys remember, you heard me go on rants about the flow in NVIDIA and the flow in Tesla and everybody just wanting to play these names or these zero revenue Oclos and quantum things, right? Like, you heard me rant enough about it. You probably couldn't take it anymore. We got the rinse here now, right? Like, again, there's still some work to be done, but we can officially say we got the rinse that we needed. We needed it. So what I think the worst thing, like from my experience, okay, the worst thing you want to do is start to just buy because things are down so much according to you. You understand? You think they're down so much. So now you were in cash, you dodged the drawdown, and now you're aggressively putting money into work because things are down in price. Yeah, I got deja vu. You may get lucky and you may get the bounce you're looking for, but there's also the possibility. You remember what happened post the 2021 rally, COVID rally into the 2022 bear market. I remember on this webinar talking to everybody about the possibility of hockey sticks, right? The hockey stick formation. Everybody was buying those Cathie Wood names, thinking, oh my God, snow is down so much over 1 month. Meanwhile, if those stocks didn't go lower, they did nothing. Now, yeah, I'm not trying to put Mag 7 into that category, okay? But you can put a lot of those speculative names in that category, all right? And, you know, I remember I had people telling me that because of AI, Microsoft couldn't be dead money. Well, I got news for you. It's dead money. This is dead. This is the definition of dead money, all right? This is what happens when every institution piles into the same names to play AI, okay? And there are no other names out there. And you get to a point where everybody owns Microsoft. You can't own any more Microsoft. These funds are not allowed to buy any more Microsoft. You understand? So it either has to come down in price enough for them to add, or they got to cut their exposure and look to add at a different time and price. You know? Yeah, Microsoft didn't get killed. It's not like Microsoft is going out of business. But if you're playing calls, it's just as good as getting killed. Right? No matter what calls you bought in Microsoft, you lost the money. I don't care what you did. You lost your money. And I think that's what people, you know, a lot of players fail to realize when you get to that point. And I think now, you know, you're at a point where you've had a nice drawdown, okay? And things have been pummeled, but it doesn't mean just because they're down so much that they're going to rip back higher. All right? And again, I think that's kind of the problem we're dealing with, where we still got to work through. Like, you still have, especially retail, they blew up their call buying. Okay, retail. Remember the option frenzy that we were looking at? That's gone. The calls blew up. Okay, they lost all their money there. But now what they've been focused on, the call buying has dried up on the retail end. Now they're buying equity. So they're dip buying equity in all their favorite names, right? Thinking, okay, now at least I don't have to worry about time. I could just buy some stock, and if it goes lower, I'll just hold. You understand? So we got to deal with that now. They gotta work them over, and they've already been doing that, you know. If you don't think people were buying Tesla on the way down, you're nuts. You know they were. Not like all of a sudden, right here, right now, everyone says, oh, yeah, I've been waiting. Now Tesla's a buy. They got burnt already quite a few times dip buying it. But that's the game, man. It happens. Again, you're in the game long enough, you see it over and over and over again. Over and over and over again. So even if you're in cash, right, looking to trade like we just went over, you look for things to tilt the odds in your favor for trades, fine. But as far as like building positions and baskets of names here, you want to nice and easy. You want to be patient, right? You want let the evidence build because nobody knows what the other side of this is going to look like. Okay, nobody knows. I don't care who you think you are, how market savvy you are, how much you know the macro side of the game. I don't care who you are. I've seen it all. I've been around them all. I've been around some of the smartest minds in this game. Nobody has a fucking clue of what the future looks like. Nobody. Okay, but this can look completely different on the other side of this, or maybe it looks the same, meaning that it could be post 2000. Okay, 2000, you had the tech blow up, and post 2000, if you own tech names, you were dead. You left the game eventually. But there was a bull market everywhere else you can possibly think of. All right, or 98, the Asian contagion, as they called it. You had tech stocks that they were hit 50, 60% off the highs, hammered. They looked like they would never catch a bid again. Everyone gave up on them. When everyone finally gave up on them, you had the biggest rally you could possibly imagine. All right, but you'll see better evidence along the way. That's right, Mr. Tim. And that's all. That's what we're getting at with everything, right? That's all. That's what we're saying, right? When the evidence builds on certain things, it just makes a higher probability of something playing out. That's all. But when you just all out crystal ball forecasting, you're playing with zero edge. No edge at all. In all likelihood, you're thinking it's not a knock. We're all in that boat. You're thinking just like everybody else. And the market likes to eat people up like that. Oh, so let's see. Yeah, let's see. Let's see how things shake out here. And again, I think if you're in a cash position, you're blessed. You be patient here. And there's going to be a time where you can get a lot more aggressive and have a lot more conviction. And that's where you can pick up the money on the long side. But it usually happens, right? Think of it. It usually happens when there are not many people around to take advantage of it, right? When most are gun shy, when the noise out there is at its worst. That's usually when that turn shows up. All right? So again, there's a lot of good out of this. Just want to stay a little on the patient side here, see how things shake out. But in the meantime, we try to lean bullish off weakness. Right? Try to catch some alpha on the long side when there's some momentum. Might probably be more difficult for bears, I guess is the better way to put it. And then we'll see how this all shakes out. It's going to be interesting. Anybody have any last questions before I wrap her up? Tomorrow we get an update on COT data, so we'll see what Sharpies, if they took off hedges, added more hedges, or whatever. We'll see what the specs have done. We could use a nice rinse there. So each and every day, each and every week has more information for us. Well, good. Yeah, tomorrow OPEX. Good call. Tomorrow you got OPEX. So those of you in the steam room, expect more of the same. Definitely in the morning, messiness. All right, maybe you get a little, one-sided action off the open first half hour, but probably would be just a lot of rolling tomorrow. Maybe it cleans up into the afternoon. Into the afternoon gets a little cleaner. But I think if we open up soft tomorrow, if there's weakness tomorrow, again, we want to lean bullish. And if it does clean up into the afternoon, see if we can catch some sort of squeeze. Even better, maybe they start buying a few things into the weakness. Flow is going to show up, guys. I'm telling you. Flow is going to show up. At some point, it's going to show up. You just want to be in decent shape for when it does. It's going to show up. I promise. All right, everybody. I appreciate you guys stopping by, talking shop. I'll see the Steam Room members mañana. The rest of you, enjoy your Friday weekend, and I'll see you guys next week. Have a good night, everybody.